Hey, good morning and happy Friday, everybody. Welcome back into Mining Stock Daily in this week's long form episode as we get you into Friday and into a long holiday weekend here in the United States. Special guest welcoming in this week, we welcome back Jesse Felder of the Felder Report, and we're going to talk all things markets, including the effects of those Nvidia earnings this week, and we are kind of getting through those Q2 earnings as well, and what it means for the stock market on the kind of precipice of a rate cut cycle. And my main question for Jesse, is it time for commodities to shine once again? So, great conversation with Jesse Felder. Special thank you to Visa Silver, Arizona Sonoran Metals, and Fireweed Metals for their continued support of the podcast. And as always, if you wouldn't mind, hit that like and subscribe on your way listening through the content. All right, everybody, let's get into my conversation with Jesse Felder. Well, Mr. Felder, it's a pleasure to have you back onto the podcast. It's been a little bit.
It's a pleasure to be back, Trevor. Thanks for having me.
Yeah, the world remains equally as crazy as it was the last time you and I spoke. Maybe even more so.
Maybe it's getting more crazy. So.
Yeah, absolutely. Listen, I think there's a number of directions we can take this conversation. We're wrapping up the month of August into a long weekend. We've got a number of things happening. Q2 financials out of the big companies, most of them have been reported. We had the main event in Nvidia earnings this week, and that had some obviously reactions within their own equity, but the full market reaction immediately following the next morning was quite something that caught me by surprise, and we'll get into that as well. We're on the precipice of a rate cut, or even maybe a rate cut cycle. Is that even safe to say? And then I also want to talk to you about commodities, and if this is maybe the time to start thinking about jumping back into the commodity sector because it's just been so beaten up. So maybe let's talk about the main news of this week, and that was Nvidia, that arguably 20 to 30% weight in the S&P. We're seeing maybe growth not as booming as it once was, and investors hit it hard in the after hours market following those earnings were published Wednesday evening. But the market reaction the following day was in the green all around. It was just an immense kind of whipsaw action. What are we seeing in this market with the highly weighted Nvidia carrying so much weight in the S&P?
I mean, to me, it just feels like a relief rally. I think, there was so much anticipation heading into the earnings report. I mean, people were calling it like the Super Bowl of earnings reports. And, it's the most important macro event of the summer. I mean, it's the build-up surrounding it has been something like I can't remember anything, as momentous or as anticipated in my career and from one individual company. So I think there was a lot of kind of angst leading up to it, worries about whether it would be a terrible report. The big question surrounding all these Magnificent Seven names that are especially the ones that are investing in AI so heavily is this $600 billion build out of AI, according to Sequoia Capital. What is the return on that investment going to look like? Where is it going to come from? And so far, there still doesn't appear to be kind of any payoff. I think that's what kind of Nvidia is reacting to, is if there isn't any payoff for these companies, is the CapEx boom going to sustain? And I think that's still an open question. All of these companies were asked on their conference calls, where's the revenue going to come from? And none of them could really answer the question effectively to say, this is the huge opportunity. And so I think that is still kind of a theme that's playing out through the market. August, obviously, we've seen a massive amount of volatility this month. Early August, we had the kind of the unwind of the yen carry trade, and a lot of those big tech stocks were kind of the focus of that selling. And a lot of them have been underperformers over the past couple of months in the market. And so I think they're still just trying to digest this how the AI capex boom is gonna play out. And I think that there was some concerns heading into the Nvidia report that were kind of showing up in the volatility markets, and the drop in the VIX today, to me, just kind of is a very clear kind of like, okay, sigh of relief for people that were maybe worried that it could have been worse.
Hmm. Uh, Maybe let's talk about volatility in the VIX. I mean, it did have that quick spike, and we haven't chatted, since then. It's been a few months since you and I've talked, and people who've listened to the podcast, I will hate me repeating this, but I went back and I looked at those spikes that went back over $60, the 60 handle on the VIX, and they were meaningful events. You had the great financial crisis, 2008, and COVID market turmoil, 2020. But the thing is, like, once the VIX hit that 60 or higher, it was a precipitous grind back down to the 20s or the teens. 3 weeks ago, this thing just happened in days. I mean, it was wild. I mean, what are we supposed to take when we see a huge spike in volatility and then a week later it's like disappears and nothing happens? What does that say?
I think it points to the fragility of the underlying market structure right now. There's a lot of things, structural things underneath the surface that have been pushing volatility lower, pushing stock prices higher. And these are just kind of systematic types of investment strategies, whether it's, the basis trade, where, a lot of big hedge funds have essentially been, not the basis trade, the dispersion trade. But the basis trade is another one, just arbitraging the treasury market. But in terms of the dispersion trade, you have hedge funds, that are shorting index volatility and buying single stock volatility as kind of another type of arbitrage that creates a depressing effect on the overall VIX. You have short volatility. That was the thing that I was so amazed by, is that spike in the VIX drew an amount of money into short vol ETFs that people literally just were like piling into the most aggressive form of buy the dip that you can imagine, which is, let's short this spike in the VIX. And that to me points out to the fragility of these trades, because if you're short volatility and it starts going against you, the unwind is you got to buy volatility while it's going up, and it's a real question whether there's going to be anybody on the other side of that trade. Now this time there was all the money that piled into the short volatility trade, and I think that was because there wasn't a real macro scare. Obviously, the rise in the yen created these kind of structural issues and things to unwind that carry trade, but there wasn't a, like Russian default or, something like that we saw in, 98 that would kind of create a sustainable rise in the VIX. So, but I think it does point out that there are these structural dynamics there that create a sense of fragility that can force the VIX up very rapidly in a short period of time. And if there were some type of a macro catalyst, you're not going to get this rapid fallback in the VIX. You're not going to get that short vol bid coming in as rapidly. And these structural dynamics in the market are really kind of overpowering any other kind of fundamental or macro trends you might want to pay attention to right now.
I wonder just the amount of quick reactionary trading that's been taking place in the last number of years, what kind of dynamic that also is having on this sharp drop down in equity, sharp spike up in volatility, and then, in a week it's all said and done with. Are we seeing any sort of signs that those zero dated option trades are slowing down at all?
It does look like the volume of those have slowed down, but I will say that retail participation hasn't, right? So, they're maybe not buying the zero date expiry call options in the way that they were, but they are buying leveraged ETFs and they are buying single stocks in a massive way. I think Vanda Research has pointed out that the retail flows into the market in that buy the dip impulse were just off the charts, especially in terms of what you expect to see in terms of seasonality this time of year. You don't expect to see much retail interest this time of year, but it came just piling in to the market. And you see things like those Nvidia leveraged ETFs, single stock ETFs, leveraged QQQ, those types of things saw massive inflows on the part of retail investors. So yeah, there is that dynamic there too. That's not just a systematic or structural thing. It's a very strong buy the dip impulse by retail investors.
Well, and it makes me wonder just where we're at in this cycle. If we're talking rate cuts, other than 2022, Jesse, where the market really got hit because of big rate hiking, a lot of rate hikes. 2022 is not a great year for equities, obviously, but people are still like almost leveraged risk to the gills. And here we are talking about potential 25, maybe 50 basis point rate cut. We can maybe talk about your thoughts on the amount of cutting we'll get in September. But it's almost like it threw no shade on the risk appetite of retail investors. It had absolutely no effect whatsoever.
Yeah.
It had effect on the system, corporate real estate, business loans, that type of macro. But on the retail investor, just throw as much out there as you can and hope for the best.
Yeah. Well, I mean, absolutely. I think, if you just look at positioning, right, people have gone all in on a soft landing narrative, right? That's the only way that, the massive, you look at the Commitment of Traders report, managed money in S&P and NASDAQ futures is about as high as it ever gets in terms of positioning. They're, net long in a massive way. But leverage, like I mentioned, leveraged ETFs too. You look at assets and leveraged ETFs, it's higher today than it was in late 2021. And even if you look at a long to short ratio, it's still about as high as it was in 2021, meaning investors are generally positioned about as aggressively as they ever have been. And the only way that works is if you get a soft landing in the economy where rate cuts, come and inflation doesn't pick back up, the economy doesn't go into recession, and everything looks good. Now, even in that situation, I think you'd probably get more of a rotation into cyclicals and those types of things than seeing the same old winners continue to run to the upside. But I think the soft landing narrative is really the what's priced in to markets right now and what investors are betting so heavily on.
I think I've asked this question before, but I still don't. What does a soft landing look like? What is it? Just no recession, no equity crash, growth reemerges, and we're off to the races thanks to AI. Is that what the soft landing is?
Yeah, I mean, I think you look back at the last rate cutting cycle that Jay Powell did, right? We saw markets kind of peak in 2018, and they were raising interest rates. He pivoted in late 18 and then started cutting in 19, and that pivot, you could say, if you didn't see the COVID crash, right? Economy was slowing and things, but it looked like stocks did really well. From that late 18 timeframe into early 2020, obviously COVID came out of the blue. It was kind of a black swan type of event. But I think investors are kind of looking back to that if we do transition to a rate cut cycle and the economy doesn't go in the toilet, then it's going to be a good time to own equities. Now, I think there's possibly a case to be made that we're already in recession right now, right? The SOM rule already triggered, and there's a number of other indicators that suggest the economy is a lot weaker than GDP or other things that are usually heavily revised months down the road might suggest right now.
Yeah. Well, maybe we should just talk about the general economy of the United States. I mean, discretionary spending is very much hurting. We've seen the financials from Home Depot and Lowe's. Obviously, those comments were very meaningful. The Dollar General stores came out this week and basically said that they are losing their customers. I mean, and that's about the most affordable stuff you can get on the retail side. Big Lots bankrupt, filing for bankruptcy, it sounds like. I mean, so it sounds like a lot of people in this economy are really hurting, and we're starting to see it in these in these discretionary type of equities and on the consumer and retail side. But those Mag 7, those tech stocks are still working higher. I mean, there's huge discrepancies between what the stock market is saying and what the economy is telling us. And it's like, don't they have to find some equilibrium somehow?
Yes, I believe so. But I think if you look under the surface, the stock market is telling a very different story than what you would glean from just looking at the level of the S&P 500 or the Dow Jones Industrial Average. I mean, I would just note that on the simplest basis, we still have a Dow theory non-confirmation where industrials are making new highs. Transports have not made a high in many, many months, which is a classic non-confirmation, and that's more of an economic indicator than a technical one, suggesting that the guts of the economy are not validating what's going on in the industrial with the stock prices in the industrials. But you just look at like you point out, retail is doing poorly. The relative strength of retail stocks has been poor. Relative strength of discretionary versus staples has been very, very weak. The breadth, the breadth warnings that we saw in June and July were literally off the charts. I mean, they're greater than anything we've seen in 20, 30 years in terms of the number of breadth warning signals that were triggered over 12 and 6 month look back period. So the stock market is actually sending some pretty clear signals that things are not as good as just the level of the S&P 500 would suggest, or the nominal GDP figures pre-revision. So I think it's important to kind of look at those things under the surface, and what are the markets saying in terms of those beneath the surface types of measures.
Does this get political in an election year? It probably already has, but it's just kind of been downplayed a little bit because everybody, one party thinks that the economy is very weak. The other party, who's in power, wants to portray the economy as remaining to be strong and continuing to work for, I guess, the lower class type of voter. How does this kind of play out as we head into that November election?
I mean, it's a good question. I think generally politics are not a huge driver of markets, especially in this day and age. You look at what economists are saying about the proposals of both candidates, and they're both saying they're out of their minds in terms of the spending and things. The fiscal, what the fiscal picture will look like under either administration is not pretty, and I think that's kind of the thing to glean. The one thing I would point out is that the biggest discrepancy between the two that matters most to investors is the potential corporate tax rate, right? Trump has said he wants to cut the corporate tax rate further, while Harris has said she wants to raise corporate tax rates. That probably matters a great deal in terms of who wins the election, and because if either one is able to kind of make that happen, it could cause it could be very bullish or bearish in the short term. But with a divided Congress, it might not be likely that either one is able to kind of do something like that. So when the markets end up kind of ignoring a lot of that stuff, that's why they end up being right.
Yeah, I do kind of want to talk about this election a little bit, because this has been on the top of my mind. I wasn't necessarily prepared to talk about it, Jesse, but I do think it's meaningful because there's so much, you can call it propaganda from both sides being thrown out. And I'm not a big fan of. I'm just economic stances. I'm not a fan of either of them. I think they're both bad candidates. And to be quite fair, I keep on going back to Trump's proposed more corporate tax cuts, and I wonder if this could be similar to what the UK had with like the Liz Truss situation, where
Yeah.
the bond market just goes off on if Trump is elected and wants more corporate taxes, what's the bond market reaction going to say? It's like, you literally cannot afford this.
Right.
So you would think that the bond vigilantes would come out there in full force and potentially like push back on this. But on the same side, you have a Kamala Harris idea of economy is just more taxes, increasing capital gains, increasing corporate taxes, capital gains. They're taking a little back step and saying, well, unrealized capital gains on people who make $100 million or more. So obviously it doesn't affect me. Probably affects you, Jesse, because you're Daddy Warbucks over here. But
I wish.
but but it's just one of those things. It's like, listen, we've got ourselves so far into a hole that I don't know there's any coming back. Neither of these ideas are hardly ideas, nor are they solutions. They're
Yeah.
just adding on to problems that we already have. And so it's just different versions of kicking cans down the road.
Yeah. Yeah, and I think you're absolutely right to think about a potential Liz Truss moment in the Treasury market. Bill Dudley, who used to be head of the New York Fed, probably has a better handle on these issues than 99.9% of the population out there, has been warning all year about the potential for that type of an event in the Treasury market. That with the direction that and he writes for Bloomberg, and for the first half of this year, he was consistently pointing out that the direction of the deficit and the amount of new Treasury issuance that has to happen in order to refinance old debt and then cover the gap that's driven by the deficit is inevitably going to create a problem in the markets. And I think this is why, Janet Yellen, I know this is why Janet Yellen has been skewing issuance towards T-bills, is because she knows that if they were to try and normalize issuance at all and start issuing more long-term treasuries, they would run into that problem a lot quicker. So, that's potentially one of those kind of political games that's being played right now. I know that, there's been a lot of talk about that recently, and a lot of data showing that, Yellen has used kind of treasury issuance to try and goose the economy and undo some of the tax hikes and stuff to try and support the economy. I think that's probably valid, but at some point they're probably going to have to try and normalize that issuance, and or even if they don't, just the growth in issuance because of the deficit is going to inevitably cause a problem. Now, when that happens, I don't know. That's anybody's guess. I would just point out that Warren Buffett has famously, when he's built up a cash pile like he's doing today, a lot of times he's put that money into zero coupon bonds, betting on a drop in interest rates associated with kind of concomitant with recession. Stan Druckenmiller, the same. Stan has said he's made like 90% of the money in his career trading the Treasury market and betting on central bank mistakes, essentially buying long-term treasuries at this point of the cycle. Neither one of these guys are buying long-term treasuries today. So that's a sign to me that two of the smartest investors in history are also very aware of this type of a risk in the Treasury market and don't want to have any part in that type of an event.
Just based on the amount of debt on the books right now, that's what they're kind of the foundation of that reasoning. They're not buying those long dated treasuries.
I think it's just supply and demand, right?
Mm-hmm.
We've seen, foreigners have had much less appetite to buy treasuries. We've had the Fed, embarking on quantitative tightening at the same time that issuance is expanding. So what we've seen right now is essentially the household sector has made up the difference, right? People are saying, "Great, I'll buy treasury bills because 5.5%, sweet," and I'm doing the same thing right along with them. And Warren Buffett is the single largest holder of T-bills right now. So that's working for right now. But at some point, potential, if issuance is to continue growing at the rate that it's growing at, that it's going to outpace demand for that debt, especially at the long end. Because I don't know who wants to buy, a long-term treasury at 4% if we're in an environment where inflation could average, close to that, just based on, the amount of monetization is going to be required in order to issue that amount of debt. So yeah, I think that yeah, basically purely a supply demand dynamic, and the supply is growing rapidly. Demand for treasuries has actually been coming down.
Okay. Um, on the cusp of this rate cutting, I mean, I guess it feels weird to say cycle because a rate cut. Let's see what happens between now and then. Also, what happens following a September cut. I think the market and most people are assuming it's going to be 25 basis point, just kind of like a dabble in the water, make everybody a little bit happy. But what are the risks of going into a full cutting cycle without some sort of deflationary event in the equity market? Are we
Yeah.
could we see a 2025 2026 resurgence of inflation because of a Fed mishap into a cutting cycle?
I absolutely think so. I mean, to cut 25, 50, even 100 basis points, take rates back down to, what, at four and a quarter to four and a half, is not going to be, too big of a problem. That probably does represent more of a normalization of policy. But markets are anticipating right now 200 basis points of cuts. And I think the only way you get that is if you do see a real, if you see recession, become a given, where people accept the fact that, okay, wow, unemployment's 5%. We're clearly in recession. GDP's, we're likely get the 2 quarters of negative real GDP. Whatever else goes into the recession calculation. So I think that there's a mismatch right now between what's priced into the Fed funds, which is recessionary type of monetary reaction, and what's priced into the stock market right now, which is soft landing. I would just point out that to me, the number one most important indicator that I look at in terms of macro and these sorts of things is the aggregate insider sell to buy ratio. So this is just taking all of the insider activity from all the top corporate executives in the United States. Are they selling their own shares? Or are they buying their own shares? And the sell to buy ratio over the last 12 months just went over 25, which is the highest that it's been since late 2021, and that's the only other time it's ever been this high. So that in late 2021, what were insiders telling you? What were these top managers of corporate America telling you? That the economy was likely to disappoint, earnings likely to disappoint over the next 12 months, and stock prices probably not do so well. And that proved very prescient, right? What do we see in 22? We saw a bear market and the economy slow. Didn't necessarily go into recession, but earnings came down pretty significantly. Today, they're saying the same thing. And as I think Najat Sehoun, who's University of Michigan business school professor, has quantified this better than anybody I've seen. This aggregate insider activity is a really good lead on, it's probably better than anything else I've looked at. Lead on economic activity, on earnings, on the stock market. And so, the fact that they're saying the same message today, which is over the next year or 18 months, economy's likely to disappoint to the downside, earnings likely to disappoint to the downside, and stock prices are going to react to that. So I think to me that probably that Fed funds futures market has it right, that we're probably going to get 200 basis points because we're going to get more evidence of rising unemployment and it's going to become more obvious that the economy is headed for recession.
I mean, 200 basis points in the long term over the next 12, 18 months, maybe I can see that. 100 basis points by the end of this year, Jesse. I mean, the market's just like drinking Kool-Aid here.
Yeah, unless we see a real rapid deterioration. I mean, jobless claims came out today, and they were in line, and they don't look too bad. Continuing claims, are showing that the labor market is pretty weak, right? People are not getting hired back on very easily right now. But yeah, we would need to see a kind of a spike in jobless claims that would suggest that the unemployment rate is going to continue rising pretty significantly to kind of come to that conclusion that 100 basis points are on the table before year end, which would mean we need at least 150 50 basis point cut. before the end of the year. I'm not going to rule that out because I think that, the data could show that the economy is weakening. You pointed out Dollar General and a lot of these things. Another one that I would point out, Jim Paulson has this great indicator that he uses, and it's the relative performance of Walmart versus the S&P 500 luxury index. And when Walmart is dramatically outperforming luxury retail stocks, it almost always leads to recession. And that's exactly what's going on today. Walmart is doing fantastically well. All these luxury names are doing terrible. And so it's literally another one of these indicators that's on par with only recessionary periods. So, I wouldn't be surprised to see more data kind of point to recession over the next couple of months that would validate the idea of deeper rate cuts.
Okay. Another kind of change in topic here, but also very pertinent. Love reading your stuff. There's a lot of your colleagues and peers we follow very closely in their daily or weekly writings. People, deep thinkers, watching markets very closely and trying to think of that next big move. What's the most forgotten now that could be the most important in the coming months? And you and a lot of the colleagues have been starting to write about commodities. It's so beaten up. There's negative sentiment across the board. Nobody wants to touch this stuff. And that usually, as a contrarian investor, that's the time where you want to really start acquiring these things because you want to be in front of the turn before it actually happens. So from metals to energy and agriculture, we've seen a meaningful drop in the dollar. That's going to have impacts on the prices of commodities here. Is it too early? Is it too early to start dabbling into commodities in general? Or are you thinking that maybe we're going to be on the cusp of one more move down in the dollar and you can start seeing commodity prices really rise hard?
No, I think now is the time to be getting aggressive in commodities. The way these things work is they sell off in the lead up to recession because people are worried about recession. So we start selling oil prices, selling energy stocks, all these things. And then as soon as recession starts, commodities start to rebound and take off. And it's because markets are forward looking, right? Stan Druckenmiller has said, I don't care what the world looks like today. I need to know what the world's going to look like 18 months from now because that's what's going to be priced in today. And so when recession starts, commodities markets start pricing in the inevitable stimulus that is coming in reaction to the onset of recession. So that's why oil prices bottom literally at the start of recession and start rising all the way through the recessionary period. What's the best performing sector? Take the last 3 bear markets outside of COVID. My friends at Investec have pointed this out. I just tweeted the chart. The best performing sector from the top of the stock market over the next 6 months is energy. And the worst performing sectors are consumer discretionary, communications, tech. So if you are worried about a recession, you actually should be buying energy stocks right now. I do think they are the most hated sector in the market right now, commodities generally. But I think that the weakness that we've seen in commodities is just another one of these signals that recession is possibly coming. And that's usually what happens is you get the sell-off in commodities into the start of recession. Recession starts, commodities take off. So by the time people get around to saying, oh my gosh, we're in recession, oil price could already be up 20% from its lows, copper price, et cetera. So I think that the time to be buying these things is when people are worried about them, selling them off. So many energy stocks today traded single-digit price-to-earnings ratios. And I would just point out, Warren Buffett is selling down his Apple holdings massively. He's been selling B of A. The only stock he's been buying, essentially, is Occidental Petroleum. And you see Carlos Slim, Mexican billionaire, doing the same thing. He's been buying PBF Energy hand over fist, $8-10 million worth of stock a day. So two of the smartest investors in North America are literally selling everything except loading up on energy stocks right now.
Yeah. What about the metals? What
Yeah.
energy is one thing, and I'm totally with you. I'm on board. I'm all in.
Yeah.
But what about the metals? A little bit different ball game here.
I'm still very bullish on precious metals. I think that where we are in the monetary cycle, we're kind of right, probably about in the middle of this bullish phase. You look back at the last Powell pivot, right? And I think gold prices bottomed in late 18, a few months before Powell pivoted, and then started taking off. And by the time they had to deal with the repo fiasco in 2019, it was off to the races. By the time COVID hit and they started cutting interest rates aggressively, right, gold and silver were ripping to the upside. So I think we're kind of in that middle phase where clearly they've pivoted. They've said they want to start cutting. So we're in this kind of middle period. Once they do start cutting, and if they have to start getting aggressive with cutting, gold prices are going to really start to accelerate to the upside. One of the things I'm paying most close attention to is at even interim peaks for the precious metals, you see investors start to chase, right? You see flows go into gold ETFs. You see silver outpace gold to the upside by a significant degree. You see the closed end funds, these Sprott funds, that you can look at the net asset value, the price to net asset value, and the discounts really kind of disappear on those things. So there's lots of fingerprints of investors chasing that you usually see at kind of a price high. None of those signs are evident yet. And so all the people that are saying, well, hey, maybe is it time to get cautious towards the metals? Not until you see retail really, really get aggressive, and they're nowhere near that point yet. So I think in terms of the monetary cycle and in terms of where we are in terms of the sentiment cycle, we're right in the middle of a bullish phase for the precious metals, and it still has plenty of room to run.
Yeah. I can give you so many examples within the metals and mining sector of just how I'm with you. There's a long ways for this to run, because even though gold's here at $2,500, you have the gold producers, some of them, the lower cost producers, are have been having great quarters. Their equity's been running 52-week plus highs. But yet, I'm telling you, as we go into this conference season, into the fall, which is usually a pretty hot time for conferences and stuff, and I'm seeing an attendee list, there's nobody new. We are still trying to sell to one another. This is it's the same. It's 2021, 2022 all over again. Nobody new is coming in.
There's just zero retail interest. I mean, this is something I point out. Some of my readers, well, Jesse, that's had such a good run. Is it time to, and look at the commitment of traders report? And I do, and I see that managed money is getting aggressive, but that's really that happens during uptrends. A lot of that's probably just commodity trading advisors, and they're just trend followers. The producers are not selling forward any product yet. Right, producers don't seem to believe that the supply and demand equation for these things is reaching the point where, hey, it's time to let's lock in these prices for production for the next few quarters. They're just not doing that. So from the producer side of things, it seems like they're still very bullish, and I don't see any signs of retail kind of over exuberance that would make me cautious just yet.
Yeah, it's almost like, and I was thinking back about, tabling gold for a little bit. The lithium boom after 2020, there was a thesis for it. The Biden administration was coming in. They were going to push electrical vehicle mandates. The consumer kind of had all the stimulus money. They wanted to buy electric vehicles. Manufacturers ramping up that CapEx to provide it to the consumers. And so obviously there was a reasoning for a booming lithium price and therefore the lithium equities. And, the same thing with, copper. There was this, electrifying the world. There's not enough supply. There's going to be a ton of demand for copper. And you saw copper run north of $5 a pound, a little bit more speculation that we can now give credit to than in hindsight. But that has come down just because, based on questioning the growing demand here in the next year or so. But those moves had a purpose. They had a narrative and a story in front of them that was clean and made sense. I just don't think the monetary the mishaps of the monetary story, the national, the global debts around the world, this cutting of interest rates maybe is going to save our butts type of thing. It just hasn't set in. That narrative is not clear as day as it once was in some of these base metals plays.
What a great point. I mean, that narrative is exactly what I'm talking about. When your neighbor can tell you the narrative for buying something, it's probably the time to sell it. When your across the street neighbor is giving you the narrative for buying something, it's probably time to sell it. And the fact that nobody can give you a narrative right now is just another sign that we've not reached that point where there's overexuberance. I'll say I think one of the potential narratives that could drive it, that could gain some traction, is if there's a case to be made that inflation's going to pick back up again. You look at overseas shipping rates, and has a really good lead on things like PPI, suggests that inflation could start to pick up again over the next few months. If you get that at the same time you get a continued rise in the unemployment rate, people are going to start talking about, oh no, stagflation, right? Oh no, we're going into recession, but inflation's picking up. Inflation's going to hold above the Fed's target, and it's really going to tie their hands in terms of doing a bunch about, in terms of stimulus. If you get a stagflation narrative, that's when your neighbor's going to go, yes, okay, inflation's a problem, it's not going away, and other assets do poorly in that type of a weak economic environment. It's literally the best possible environment for precious metals. That's a potential narrative that I could see over the next year or two that could start driving some retail interest if the data moves in that direction.
Okay. Jesse, I'm going to leave it at that. Great conversation to lead us into a long holiday weekend. In fact, I would say we're recording this Thursday afternoon. The market was green. The NASDAQ was up 1.5%. And since you were talking, it's now flat. So I don't know exactly what happened, but in the last 40 minutes, this thing turned.
Right? It's crazy times.
It's crazy times. All right. Jesse Felder from thefelderreport.com. Great publication. Even just the free blogs you publish are well worth the time and the insight. Always a pleasure to have you onto the podcast, and have a great long weekend, Jesse. I hope you rest up.
You too, Trevor. Thanks for having me. Always fun to chat with you.